Getting started in investing can be a daunting task for many. Researching what industry you want to invest in, finding the companies with the best returns, trying to figure out what in the world a P/E ratio is. While all this research can be interesting, there is a fundamental problem with trying to crack the code of the stock market. Nobody has done it. Actively managed portfolios ran by traders can often beat the market. However, just as often, the time and money spent managing it can burn through much of those profits. On top of that, there are also tax disadvantages for buying and selling in quick succession. So, what is a person supposed to do when they want to start investing? First, let's talk about the random walk hypothesis. This is a financial theory that suggests the price changes of an individual stock are random and cannot be predicted. That sounds bad, but there's a strategy that emerges from the randomness. Since its inception, stocks have been increasing in value over the long run, some years bad, most years good, which makes a random assortment of stocks more likely to provide a better overall return than any one specific stock. This is where the term random walk stems from. It's the random walk down Wall Street and just picking stocks at random. So wouldn't it be great if you didn't have to go out and buy a share of everything? That's exactly what indexes and ETFs aim to do. There are some differences between indexes and ETFs. An ETF can be bought and sold at any point during the day, just like any other stock, while an index fund can be bought and sold only at the end of the day. Since ETFs can be sold at any point during the trading day, they're considered to be more liquid, meaning they can be converted to cash more quickly. And now just a quick example of what liquidity means. If you have $1 in your hand, that's the most liquid asset you could possibly have, since it's already cash. You can go out and buy anything with it. Something like a gold bar can be sold for cash rather quickly, while something like a house takes some time to sell and is therefore less liquid. Anyway, back to indexes. Aside from liquidity, there are very little differences in risk and performance between an index and an ETF, so from here on out, we'll be using the term index and ETF interchangeably. Just keep a mental note that there is a slight difference. Popular indexes include things like the Dow Jones, the S&P 500, and the NASDAQ. Each of these funds follow their own basic rules that are more or less automatic with their strategy, which lowers the cost of their upkeep. So how do these indexes work? What's the strategy behind them? Well, a lot of them are different, but we can find the basic rules each one uses. So let's look at one. Let's look at the S&P 500. To be listed on the S&P 500, a company should be from the United States, which makes sense for a US-based index, have a market cap of at least $8.2 billion. They don't want small companies in there, big fish only. Its shares must be highly liquid, which means that it's traded a lot, usually 100 times more per day, and at least $1 million worth of trades each day. If a stock is listed publicly but is seldom traded, it would not be considered liquid. Keep in mind, in order to buy something, someone has to be willing to sell it, and vice versa. So if a stock does not have anyone willing to buy it or sell it at any given time, you'll have to wait a while to sell it for the value it was listed at. This is usually no problem for a large company. At least 50% of its outstanding shares must be available for public trading. This means that a company has to have sold the majority of its stake to public investors. In other words, if you found a company and sell just 25% of it to investors to retain control, you would not qualify to be on the S&P 500. It must report positive earnings in the most recent quarter. If you're not in the business of making money, then there's a problem. And the sum of the earnings in the previous 4 quarters must be positive. Again, if you're not turning a profit, there's a problem here. Any company that meets these rules is eligible to be on the S&P. However, as the name suggests, They're limited to the top 500 companies based on their market cap. Also, what do we mean by market cap? It's short for market capitalization, which is a measure of the total value of a publicly traded company's shares held by its shareholders. To find the market cap, you would simply take the number of shares and multiply it by the price of the stock. So if you had a company with 1 million shares, each worth $100, you would do $100 times 1 million shares, giving the company a market cap of $100 million. Now that we covered market caps, we can get a little more specific on how the S&P is calculated. It's weighted based on the market cap of each company, meaning as the company becomes larger, it also becomes a larger component of the S&P. The actual formula for the calculation is this, but for our purposes, the basic mechanics will suffice. So how does all of this relate to the random walk hypothesis? By using indexes like the S&P, you're buying little pieces of a bunch of companies that collectively make up almost 80% of the American equity market. By getting a little bit of everything, you maximize your chances of getting an overall positive return, while minimizing overall risk. Now this all sounds nice, so how does someone buy one of these index ETF things? Well, first you have to open an account with a broker. This can be a person like in ye olde days, but it can also be done online through a broker like TD Ameritrade, or Robinhood, or Vanguard. ETFs can also be based around certain industries like mining, semiconductors, or really any industry you can think of. So if you feel strongly that an industry will do well, but are not sure which specific company to buy, you can use one of these specialized ETFs. Other ETFs can offer more risk and more reward, such as the S&P 100, which uses similar rules to the S&P 500, but is based on the top 100 companies. There are all kinds of ETFs out there that can fit your risk appetite or affinity for specific industries. Buying an ETF is a very common passive investing strategy that historically has worked out very well.